U.S. stocks saw a sharp sell-off on Tuesday, with a broad decline across the tech software sector, dragging down the S&P 500 and Nasdaq. This turbulence, dubbed a software reckoning by the market, was triggered directly by a legal automation tool launched by AI startup Anthropic. The tool's efficiency in tasks like contract review forced investors to fundamentally reassess the long-term business models and value of traditional software services. The panic was writ large in stock prices. Thomson Reuters shares plunged roughly 21% intraday, while LegalZoom fell over 20%. This violent reaction stems from a deep-seated fear. If a single AI plugin can replace the functions of multiple expensive specialized software suites, the traditional per-seat subscription model is in jeopardy. Pressure from AI advances has been building since January. The core logic of the industry is under attack. The high-margin recurring revenue of the SaaS model relies on tying user counts to software functions. In the age of AI agents, a single agent can replace the productivity of multiple human users, directly undermining software firms' pricing power and growth certainty. The current earnings season confirms the sector's distress. The proportion of S&P 500 software companies beating revenue estimates lags significantly behind the broader tech sector. This suggests many legacy software firms are on the back foot in the early distribution of AI's transformative benefits. Even a giant like Microsoft hasn't escaped scrutiny, with the pace of its cloud growth and the efficiency of its massive AI capex in focus. However, the sell-off isn't indiscriminate. Palantir's stock surged against the trend after reporting 70% revenue growth, clearly illustrating the market's new filter. Capital is fleeing companies with narrow, easily replaceable products and flowing to those deeply integrating AI into complex workflows to build durable moats. From a macro perspective, this shakeup looks more like a sector rotation. As money fled software stocks, it flowed into more defensive sectors like retail and logistics, a classic risk-off move. This reflects investors shifting from highly valued growth narratives toward areas of perceived stability amid uncertainty. Notably, extreme sentiment often creates opportunity. Valuations for some fundamentally sound software firms have dropped to levels, and oversold technical indicators are starting to attract the attention of long-term institutional investors. They believe companies with irreplaceable data assets and deep domain expertise will ultimately adapt and find new growth paths. Looking ahead, 2026 could be a watershed year for the software industry's evolution. Generative AI and agent technologies are rewriting how software value is created. The future leaders may no longer be mere tool providers, but organizations that successfully transform themselves into the core intelligence engines for vertical-specific solutions. For investors, the current volatility offers a clear guide. Investment decisions must look past sector labels and deeply analyze whose moats are being eroded by AI and whose competitive edge is being fortified. This market correction, sparked by a single AI plugin, is ultimately a test of every participant's grasp on the nature of technological disruption.